This is Michael, and you've reached Module 6, Partnering, Leveraging, and Scaling Inside Your IRA. So far, you've learned how self-direction works, how to stay compliant, and how tax-deferred or tax-free strategies may apply depending on your account type. In this module, we focus on how partnerships and limited leverage can be used inside retirement accounts, along with the rules, structures, and considerations that keep everything properly compliant. Partnering within your individual retirement account allows for resource pooling and access to larger investments. By using non-recourse financing, you can scale opportunities while ensuring internal revenue service compliance. Structures like limited liability companies or joint ventures enable diverse participation, but must be arm's length and well documented to avoid prohibited transactions. Always consult professionals for guidance. Partnering in self-directed accounts allows combining resources to access larger assets. Participants can include multiple individual retirement accounts with unrelated investors, or combined retirement plans like individual retirement account and 401k. Forming limited liability companies or joint ventures is common. Ensure all arrangements are arm's length, documented, and structured to avoid prohibited transactions, maintaining internal revenue service compliance. Individual retirement account to individual retirement account partnerships involve multiple individual retirement accounts purchasing an asset with proportional ownership, such as a 60-40 split. In individual retirement account to cash partnerships, personal funds can only be used during acquisition, ensuring no self-dealing. Unrelated investors can partner with individual retirement accounts, provided no disqualified persons are involved. Individual retirement accounts can also own limited liability company or joint venture interests for real estate or projects. For internal revenue service compliance, ownership is based on initial contributions. For example, if one individual retirement account contributes $6,000 and another $4,000, ownership is 60% and 40%, respectively. All income and expenses must adhere to these percentages. Proper title documentation, like custodian name for benefit of individual retirement account, 60% interest, ensures transparency and compliance. Partnering in retirement accounts allows access to larger opportunities by pooling resources for substantial projects. It diversifies investments across various assets and markets, reducing risk. This strategy unlocks exclusive deals and maintains compliance, protecting tax advantages. However, it doesn't guarantee profits, as outcomes depend on market conditions and asset management. Non-recourse loans enable retirement accounts to use financing while maintaining compliance. The individual retirement account is the borrower, with the property as collateral, ensuring no personal liability. This structure enhances purchasing power. For example, an individual retirement account with $10,000 can acquire a $20,000 property using a $10,000 non-recourse loan. Note: unrelated debt-financed income may apply, requiring certified public accountant consultation. Self-directed accounts enable diverse partnership structures. Multiple small individual retirement accounts can pool resources to acquire property, sharing ownership based on contributions. Individual retirement accounts can also engage in private lending, earning tax-deferred interest. Additionally, individual retirement accounts can hold limited liability company membership interests for joint projects. Generational partnerships allow wealth building across family individual retirement accounts, ensuring compliance by avoiding disqualified persons. Scaling your self-directed portfolio involves strategic expansion, not guaranteed growth. Reinvest gains into new opportunities to enhance tax-advantaged growth. Collaborate with additional individual retirement accounts for diversification. Diversify across asset categories to mitigate risk. Use non-recourse financing to boost purchasing power while managing cash flow and unrelated debt-financed income. Maintain meticulous documentation for compliance and audit protection. Proper documentation is crucial for internal revenue service compliance and safeguarding your account's tax advantage status. Ensure operating agreements define terms, ownership percentages are documented, and custodian paperwork is complete. Allocate income and expenses proportionally, agree on exit terms, and use non-recourse loan documents if leveraging. This creates a clear audit trail and protects all parties. Partnerships and limited leverage can expand individual retirement account or 401k opportunities under Internal Revenue Service regulations. Ensure arm's-length transactions with unrelated parties to avoid self-dealing. Avoid deals with disqualified persons. Use non-recourse loans with no personal guarantees. Create comprehensive agreements and work with qualified professionals to protect tax advantage status and ensure compliance. In the next module, we'll explore how retirement accounts can be used in additional real estate strategies with proper compliance and documentation.